You owned your home for 30 years. You sold it last year. You made a profit. You thought, the government gives homeowners a tax exclusion. I am fine. Then an IRS notice arrives. It says you owe thousands of dollars in taxes you never reported. You did not lie. You did not cheat. You simply did not know about 4 specific IRS rules that apply directly to senior homeowners. Right now, thousands of seniors are receiving these notices, not because they did anything dishonest, because nobody told them these traps existed. I am going to show you all 4 today, so you never get that letter. I am Faria, Senior Policy Analyst and Retirement Finance Expert. I read the official IRS publications, so you do not have to. Today, 4 hidden tax traps directly from IRS.gov that every senior homeowner needs to know about right now. Margaret is 71. She lived in her home in Florida for 28 years. Last year, she sold it for $680,000. She paid $180,000 for it originally. Her gain, $500,000. She and her late husband had filed jointly, so she knew about the $500,000 exclusion. She assumed the entire gain was tax-free. She did not report the sale on her tax return. 3 months later, an IRS notice arrived. The problem? For the last 6 years, Margaret had rented her spare bedroom on a short-term rental platform. She had claimed depreciation deductions on that portion of her home every year. The IRS matched those prior depreciation claims against her home sale. That depreciation, approximately $18,400, could not be excluded. It was taxed as ordinary income. Margaret also received Form 1099-S from her closing agent, which automatically reported the sale to the IRS. Because she had not reported it herself, the IRS assumed the entire amount was taxable. Margaret owed back taxes, interest, and a 20% accuracy penalty, all because of 2 traps she never knew existed. Today, I am going to walk you through all 4. Tax Trap 1. The home sale exclusion rules. Most seniors get wrong. If you sell your main home at a profit, the IRS allows you to exclude up to $250,000 of that gain from your taxes. If you are married filing jointly, that exclusion increases to $500,000. But to qualify, you must pass 2 tests. Ownership test. You must have owned the home for at least 2 years out of the last 5 years before the sale. Use test. You must have lived in the home as your main residence for at least 2 years out of the last 5 years. Both tests must be satisfied. Now here is the trap most seniors fall into. If you received Form 1099-S, proceeds from real estate transactions from your closing agent, you must report the sale on your tax return, even if your entire gain qualifies for the exclusion, even if you owe 0 taxes. The IRS receives a copy of that Form 1099-S automatically. If you do not report the sale, the IRS will assume the full amount is taxable income and send you a bill. Second trap. If you own more than one home, the exclusion only applies to your main home. Any profit from selling a vacation home, a rental property, or a second residence is fully taxable. No exclusion, no exceptions. Tax Trap 2. The home equity loan interest trap. Many senior homeowners took out home equity loans over the past decade. Some used that money to pay off credit cards, pay medical bills, cover living expenses, and every year, they deducted that interest on their tax return. Here is the IRS rule, effective since 2018 and still in force today. Interest on a home equity loan is only deductible if the money was used to buy, build, or substantially improve the home that secures the loan. If you used your home equity loan to pay off personal debts, credit cards, car loans, medical bills, that interest is not deductible. It does not matter that the loan is secured by your home. What matters is what you did with the money. Many seniors have been claiming this deduction incorrectly for years. The IRS matches Form 1098, your mortgage interest statement, against your Schedule A deductions. If the proceeds were used for personal expenses, the deduction is disallowed. Back taxes, Interest, penalties. Check your past returns. If you claimed this deduction on a home equity loan used for personal expenses, speak to a tax professional about filing an amended return. Tax Trap 3, the SALT cap. Most seniors are misreading. SALT stands for state and local taxes. Under the new One Big Beautiful Bill, the SALT deduction cap increased from $10,000 to $40,000 per year starting in 2025. This sounds like great news for seniors in high-tax states: New York, New Jersey, California, Illinois. But here is the trap. That $40,000 cap applies to all state and local taxes combined. State income taxes plus local income taxes plus property taxes, all added together, cannot exceed $40,000. Many seniors assume the $40,000 is just for property taxes. It is not. If your state income tax is $15,000 and your property tax is $18,000, your combined SALT is $33,000. You are under the cap? Fine. But if your state income tax is $22,000 and your property tax is $24,000, your combined SALT is $46,000. You can only deduct $40,000. The $6,000 excess is gone. Also, there are specific items you can never deduct regardless of the cap. Transfer taxes paid when you sell your home, not deductible. Homeowner association fees, not deductible. Service charges for water, sewer, or trash, not deductible. Know exactly what is included in your SALT before you file. Tax Trap 4. Renting or using your home for business reduces your exclusion. This is the trap that hit Margaret, and it is the one most seniors never see coming. If you ever rented part of your home, even one room on a short-term rental platform, or used part of your home as a dedicated business office, the IRS rules change at the time of sale. Here is exactly what happens. Any depreciation you claimed in prior years for the rental or business portion of your home cannot be excluded from your gain. This is called depreciation recapture, and it is taxed as ordinary income, not at the lower capital gains rate. Example, you sold your home at a $400,000 gain. Full exclusion applies. But over 8 years of rental use, you claimed $22,000 in depreciation deductions. That $22,000 cannot be excluded. It is taxed as ordinary income at your regular tax rate. The IRS automatically matches prior depreciation claims from your old Schedule E filings against the gain you report on your home sale. If the numbers do not match, automatic notice. On top of that, if the rental portion of your home was physically separate from the living area, a detached unit, a converted garage, a basement apartment, it may be treated as a completely separate property for tax purposes, meaning the exclusion may not apply to that portion at all. If you ever rented any part of your home or claimed home office deductions, get IRS Publication 523 before you sell. It has specific worksheets to calculate exactly how much of your gain is excludable. Do not guess on this one. 3 steps. Write these down. Step 1. Before you sell, get IRS Publication 523. Go to irs.gov and search Publication 523, Selling Your Home. This is the official IRS guide for home sales. It includes worksheets for calculating your exact exclusion, including adjustments for rental use, business use, and depreciation recapture. Do not rely on your memory or assumptions. Run the worksheet before you close. If your situation involves rental history or home office deductions, bring Publication 523 to your tax preparer and review it together. Step 2. Check every home equity loan you claimed as a deduction. Pull out your last 3 years of tax returns. Look at Schedule A, Itemized Deductions. If you claimed home equity loan interest, ask yourself, what did I use that money for? If the answer is anything other than buying, building, or substantially improving your home, that deduction may be incorrect. Contact a tax professional about filing Form 1040X, the amended return, to correct it before the IRS finds it first. The IRS gives you 3 years from the original filing deadline to amend. Step 3. Calculate your real SALT deduction before filing. Add up all your state and local taxes paid in 2025, state income tax, local income tax, property taxes, all combined. If that total is under $40,000, you can deduct the full amount on Schedule A. If it exceeds $40,000, you can only deduct $40,000. Do not include transfer taxes from a home sale, HOA fees, or utility service charges. These are never deductible regardless of the cap. And if your MAGI exceeded $500,000, the $40,000 cap begins to phase down. Check the schedule. A instructions on irs.gov for the exact calculation. The IRS knows about your home sale the moment your closing agent files Form 1099-S. The IRS knows about your prior depreciation claims from every Schedule E you ever filed. The IRS knows about the interest reported on your Form 1098. They have all of it. The only question is whether your tax return matches what they already know. These 4 traps catch thousands of senior homeowners every year. Not because they cheated, because they did not know the rules. Subscribe to this channel so you never miss a critical update. Share this video with any senior homeowner in your life who is thinking about selling or who has claimed home equity interest or rental deductions in the past. One of these 4 traps could be sitting in their prior returns right now. I am Faria. See you in the next video. Stay informed. Protect what you have built.